This podcast is for informational purposes only and is not intended as tax, accounting, financial, or legal advice. Quick question. When was the last time you gave your insurance a serious review? For a lot of young families, the honest answer is it's been a while. Today, I'm talking with Dan Sullivan, Managing Director at First Element Insurance Planners, on how best to think this all through. Life insurance, long-term disability, and the property and liability coverage most people forget about until it's too late. Quick disclosure before we get into it. I'm a fee-only financial planner. I'm not licensed to sell insurance, and I don't receive any referral fees, commissions, or compensation of any kind from Dan or First Element Insurance. I bring third-party partners into client conversations when I feel it is the best fit for their unique needs. This is a practical, no sales pitch primer for anyone building a family and trying to manage risk the right way. Okay, let's go. Welcome, everybody, to another episode of the Sandwich Bread Podcast. I'm your host, Tom Kaminski. These are conversations about life and money for the sandwich generation. And I'm very excited for today to have on our show Dan Sullivan. He is the Managing Director at First Element Insurance Planners. Welcome, Dan.
Thank you, Tom. Great to be here.
Dan's the Managing Director at First Element Insurance Planners, and he uses his background with insurance planning and legal counseling to help fee-only advisory firms provide client-friendly solutions for their own clients in proactive ways. I'm a fee-only financial planner, meaning that I am not licensed to sell insurance. And so when a client has an insurance need that I identify, that's where I'll leverage Dan's firm and his services to find really good, low-cost, appropriate solutions for the clients.
That was a great description.
So Dan, tell us a little bit about your background.
Sure.
I know you got your law degree from St. Louis University in 2011, but what kind of led you down the path of joining First Element?
Yeah. So when I graduated from law school, I started my legal career in litigation, and most of what I was doing related to insurance. So 6 to 7 years in, I kept feeling the same thing, that whether I was in court or in a deposition or just meeting with the client, just feeling like this could have been avoided if the right planning had been done. And so ultimately I decided I want to be looking at what risks people are facing and try to mitigate those rather than being in the world of cleaning up the messes. I decided that going down the planning route was going to be better for myself.
Get out in front of the problems rather than litigate on the back end. And then what attracted you to First Element?
I was able to use my insurance law background, my knowledge about the way the contracts work, the way the industry works. That really drew me to this side of things. And First Element.
When a financial advisor is licensed to sell insurance, there can be a conflict there, right? I present a policy to you and I stand to earn a commission upfront and potentially ongoing for the product that you purchase. And so what a lot of advisors do, like myself, is we don't get licensed to sell insurance, or fee only, meaning that we don't derive fees from commissions, but it creates a need for a partner to fill that gap.
And so the people on our team, they're all salaried. They're not themselves earning commissions from any one client that they're helping. We work directly with the advisor to make sure that they're comfortable with the recommendation before that's presented to the client.
Well, let's get into the kind of key topics for today's episode. Sure. We are looking at most common risks facing young families and the insurance you should consider to try to offset those risks. So let's jump into probably the best known insurance out there, and that is life insurance. Yep. So high level, what are some important questions, Dan, that a young family should consider relative to life insurance?
Absolutely. A financial planner once said he wanted his clients not to be simply consumers of insurance. He wanted his clients to be managers of risk. And so that's the lens through which we try to look at all of this. It really just starts with, what is the need? That's the most important question. How long do I need this insurance? Probably the first question to ask when you're thinking about life insurance. The conversation is a little bit morbid, talking about death. Always. But if I were to die, I'm 40 years old between now and when I turn 65. That's when I need life insurance. That's when there's the biggest risk to my family, because I'm earning an income that partially supports my family. There are some people who have a need no matter when they die. For most people, especially people that are in their 30s and 40s, it's coverage for a specific period of time. So term life insurance is going to be the best option because it's the most cost-effective way to guarantee that coverage is available.
Yeah. I like that framing of rather than consumers of insurance, managers of risk, because my clients, I'm like, hopefully these premiums are wasted money, right? We're like, we don't want to use life insurance.
Right.
That means
Exactly.
someone died. We're creating a bridge to the next phase of your life or your financial situation. It's a safety net for a period of time that you need insurance because your income is too valuable or your college savings needs are too much, and then hopefully reduce or eliminate the life insurance as their net worths grow. I think you need to know the reason why you're getting life insurance. Let's understand the risk you're trying to offset. Dan, from your side of the fence, with you and your team, purchasing and reviewing tens of thousands of policies a year, what are some common pitfalls you see with life insurance?
That's going to be the death benefit that's needed. Yeah. And this is a really big one. And we see it a lot. Somebody will either say 10 times my salary, or my brother-in-law got $500,000 of death benefit, so I'm going to get $500,000 of death benefit. Things like that, where you're not really thinking through, how much do I need? We have a very simple calculator that we use to help clients. It's not a difficult assessment. So taking those extra 2, 3, maybe 5 minutes to go through that and arrive at the number that's going to be most appropriate for your family, it is a good thing to do.
That's great. So if your neighbor has 2 million in term life, don't just say, oh, well, I guess I need that too,
Right.
And spend a little bit of time. And if you're working with a financial professional, they should be proactively helping you with this, but lean on them and say, this is what I'm thinking. All right. What's the next one you see, Dan?
Another one that we see is what I call paralysis by analysis. There's so much out there. There's different types of products. You can choose among different term lengths, different death benefit amounts. And if you don't know what you need, it can be difficult to make a decision that you feel confident about. And I think this is something that, Tom, you and other financial planners can really help your clients with, dialing in. This is the type of product that I would recommend for your situation. This is the length of coverage I think you need and the amount that would be appropriate. But without that kind of direction, it can just be difficult to know what you need.
And sometimes we see a paralysis when they get to the premiums, where this is the thousands potentially of dollars you are going to throw away, quote unquote, each year for the purchase of an insurance policy. It's better to have insurance than not, in almost all cases when there's a need. And so I have these different strategies I'll use to just try to get us moving, in the right direction.
Yeah. Laddering coverage is a good one. If it's a situation where the money for premiums is tight right now, then buying a shorter duration to cover the gap right now and letting them come back later when they feel like they're on better financial footing to pay premiums on a policy that's going to take them for the rest of their duration can also help.
Yeah, smart. Okay. And then next common pitfall. We've got choosing a product that doesn't meet their needs. So tell us a little bit about that, Dan.
Yeah. When it comes to product types that are not appropriate for the client's needs, usually what we find is one of two things. It's using a permanent product to try to solve a temporary need. So whole life insurance, other types of permanent insurance, instead of the term life insurance, leads to a far higher premium, usually at the expense of getting the right amount of death benefit. And so that's a very common pitfall. Another is using what's called annual renewable term insurance versus level term insurance. With a level term policy, if it's a 10-year term, you have a guaranteed premium for 10 years. With an annual renewable term policy, the premium goes up each year that it renews. The early years premiums are very low and they can be attractive. But once you get into your 40s and 50s and beyond, those premiums start going up and they go up very rapidly. So choosing a level term premium at the start, even if the annual renewable term looks attractive from a premium standpoint, usually makes a lot of sense, because in the long run, it'll be a lower.
So we touched on the idea of laddering insurance. And for the audience, that's basically procuring a couple of different policies that are very similar, right? You've got a life insurance need of $2 million. Maybe we, instead of purchasing one $2 million life insurance policy, we buy $1 million, a $500,000 and a $500,000. And essentially you're breaking that policy into chunks that you can then sunset at the appropriate duration. That can save you on some premium and costs. Do you have any other strategies that that you see out there to help lower premiums for folks?
Sure. The biggest one has to do with underwriting. So, by just gathering some very basic health information at the beginning of the process, we can make sure that first we're setting appropriate expectations for here's what we think the premium is going to be based on what you told us about yourself. There are dozens and dozens of insurance carriers out there who are helping clients with term life insurance. So, different carriers look at different risks differently. And if there's one carrier that's going to look at a certain risk, smoking cigars or a health condition, something like that, if they're going to look at it differently from another carrier, then we want to go to the carrier who's going to look at it more favorably. And that's something that can help reduce premiums as well.
I kind of frame this with my clients as the interview before the interview.
Yeah, the way I think of it is it's a low stakes introduction to the invasiveness that can happen in a life insurance application process. So you're going to have to answer questions having to do with your health, having to do with if you've ever used nicotine or other substances, what your family's health is, generally speaking. Yeah. So those aren't always the most comfortable questions. And if you've had experience having to answer them when you're just talking with our team or your insurance provider, then when it actually comes time to answer those questions for the carrier, it's a little more.
It's old hat. Awesome. So that concludes the life insurance section, which it's toughest in my view for the consumer to digest. So next up, let's jump into long-term disability insurance. Dan, what are your thoughts on this general category?
It's another really important way to protect your income. What most people don't think about is the fact that during your career, you're much more likely to be disabled than you are to pass away.
Yeah, and I've heard the statistic, Dan, something like 25% of individuals will use long-term disability at some point during their career from the start of their working years, so age 22 through 65.
I believe it's about 1 in 8 that will have a longer disability, more than 5 years.
Well, in my view as a planner, I worry more about long-term disability for my clients than life insurance. Both are super important and need to be addressed. But if my families have a couple young kids and one primary source of income for the family, first thing I look at is if they became disabled for a long period of time, what would that mean for their family cash flow? Could they survive on the disability payments? And if the answer is no, we need to close that gap and address that with an insurance policy.
Yeah. One thing we do find is that people have sort of a misconception that disability is for when you get injured. And if I were injured, I work at a desk. So unless there was something that really altered my mental capacity or my ability to type or something like that, I'm still going to keep working. The reality is that most disability claims are actually due to illness, with cancer being a big one, unfortunately. But if you think about the last time you had a really bad flu or were really ill and were you able to work? I've been shut down for several days because I was, sick to the point where I couldn't work. Now imagine something that was much more severe as far as illness goes. And I think that is a helpful perspective when thinking about the potential risk and the potential consequences of truly not being able to work because of illness.
Yeah. Okay. And again, much more commonly used than life insurance. Yeah. Each person's health history is super unique. Right. So, but what roughly do you see as a broad stroke for the listeners?
Yeah. And it can be more expensive in terms of premiums, a higher premium than what you would get with your term life insurance, because as we've already discussed, the likelihood of needing it is higher. It does vary based on the person and their health history, a number of different factors. But typically what we see is for the amount of income that you're covering, about 1% to 4% of that income.
Got it. How should they think about analyzing their current coverage? Where should they start? What should they look at? And then how should they think about identifying any gaps and how best to fill that with insurance?
Yeah, luckily many employers offer this as an employee benefit. So start with, what does your group plan cover? Often it's up to 60%, but it might have a lower cap. So it's important to know what that's providing. And then looking at, if I were disabled long term, would that benefit amount be sufficient for my needs, my family's needs? And often what people decide to do then is supplement that group coverage with an individual disability.
Yep. So for the listeners, if you've got a great employer and they provide long-term disability group coverage, a really powerful benefit, but they often have caps. Maybe it's 60% of your income they'll cover, but it caps at $10,000 a month. Well, if your income, your take home is say $400,000 a year, then 60% of that is $240,000 a year. Well, if it caps at $10,000 a month, disability policy will actually only cover $120,000 a year of your income. So you're currently making $400,000, but your disability policy will only cover $120,000, right? And so I illuminate that for my clients and say, we have a big gap here. Is your family comfortable based on your spending to live off of $120,000 a year? If the answer is no, which is often the case, then you analyze and fill that space with the supplemental policy. I'll also add a note for folks. When you're analyzing your policy, talk to your employer and ask them if this will be a tax-free disability benefit or a taxable benefit. So you're looking at $120,000 a year tax-free. And so that's where this 60% number, I find that like 66% really getting a lot closer to actually replicating your net tax paycheck that you take home.
And I can't give tax or legal advice. So as Tom said, consult your tax counsel before making decisions. But if it is a taxable benefit, that's another area where an individual plan can step in and cover some of that ground. Because typically with an individual long-term disability plan, you're paying with after-tax dollars. And so the benefit is received income tax-free. So that can help.
So ping your HR representative if you do have disability insurance and ask them, how are these premiums paid and will the benefit be tax-free or taxable? Excellent, Dan. All right. I think you had a note on here, which I think is very smart for folks that are credentialed, whatever your industry is. You're part of a trade association, explore long-term disability group benefits through that trade association or professional credentialing network. I personally have procured a long-term disability policy for myself because purchasing it based on yourself can be more expensive, but in a group environment, there can be some purchasing power and premiums may be a little bit lower for you. One last comment, Dan. There is one specific component of long-term disability policies that I think is really important for folks to understand. Definition of disability. Could you walk us through own occupation versus any occupation?
Yes. So the definition of disability is critical because it really determines whether you're going to get a benefit paid in many situations. So own occupation is going to be the highest level of coverage you can get. And what it basically means is that if you're disabled and can no longer do the material and substantial duties of your own occupation, the job that you were trained and educated for, then that triggers a disability benefit. Any occupation, by contrast, is if you can no longer do the job duties of any occupation. That's when disability benefits are triggered. So, if you are a surgeon and you badly injure your hand and you can no longer do surgery, then with an own occupation definition of disability, you'd be entitled to benefits under that plan, even if you could do something else. If you could go and be a medical professor or something like that.
Got it.
Within any occupation definition, as long as you can do any job, working as a greeter at a store or anything like that, then you wouldn't be able to collect benefits on your plan. There's sort of a spectrum of coverage. So definitely something to talk to your financial professional or HR representative.
Understand the definition of disability. Spend a little bit of time on that. Know what you're getting into with the purchase of that policy and be comfortable with that because it can be a huge component of how you get paid or if you get paid at all. Next up, for a young family is property and liability. And what we mean by that is home, auto, and umbrella coverages. Dan, do you just have some general guidance for this category that you'd like to share?
Sure. I think there are a lot of people who would say that they don't know when the last time they reviewed their home and auto coverages. Just making sure that you understand what your insurance policies are covering is an important thing to do. So starting with reviews, that's a really big one. Yeah. When it comes to home insurance, the biggest thing there is sure that the limit of liability is appropriate given the current cost to rebuild the home. There are many people out there who have insurance coverage that if they were to lose their home, say in a fire, they would be out 5 to 6 figures in out-of-pocket costs because of the fact that the cost to rebuild homes has gone up.
Yeah.
The value of their home has gone up, but their coverage has not changed. So that's a big piece to make sure is reviewed and is appropriate for your situation.
Yeah, very important. Those are things we look at. And I'll kind of play the other side of the coin on this one a little bit too. Sometimes I see folks way overinsured because the land itself is extremely valuable, but the rebuilding costs on the home are substantially lower. And if you're insured for $2 million, but really the rebuilding costs are $600,000, let's have that dialogue with the insurance professional and understand where we might be overinsured. But to Dan's point, much more commonly, I'll see potential underinsurance because building costs are just far different since COVID. Honestly, every year it continues to go up pretty substantially from inflation, and there can be a big gap there.
You're right. It can go either way.
And then auto coverage, you have kind of general guidelines for auto other than review regularly with your professional?
Regularly, and especially if you're getting to the point where you've got teenage drivers, that's definitely a good time to review because the costs go up substantially at that point. So that's an important one to hit, making sure that you've got all the different coverages that are offered that are important to your life. Liability, certainly, collision, comprehensive, making sure that your limits there are appropriate given your situation is a good thing to do.
And then last but not least, another important one, umbrella coverage. General thoughts on that one?
Yeah, this is one that's overlooked, I think, too often. And it's a big potential risk because if you drive to work, if you have people over at your house, there are lots of situations that we put ourselves in on a regular basis where we could be liable for somebody else's injury. If I'm at fault in an auto accident and somebody's injured, then they have a claim against me personally. So making sure that the appropriate amount of coverage there is there to cover a potential lawsuit and a judgment against me is something that I definitely want to have in place. So umbrella coverage is relatively cheap for what you're getting. So adding that is a good move.
Yeah, it sounds like it'd be expensive when you say, well, we'll get a $2 million umbrella policy. Often it's a few $100 a year in premiums. And very important, your finances change pretty dramatically when you graduate from school, you pay off your loans, and then you suddenly have a pretty high paying job and your net worth starts to grow. You want to understand what assets you've got that might be exposed to a lawsuit and insure accordingly. Very important. With my clients, I look at that annually because their net worths change pretty quickly. So analyze and reanalyze regularly.
That's right.
Outstanding. All right, Dan, that concludes this episode. Today we ran through life insurance considerations, what to consider, common pitfalls, tips for improving premiums, long-term disability insurance, then property liability, just high-level considerations as you build your family and grow your family for property, auto, umbrella, home coverages to ensure that you're staying on top of your game there as well. So we covered a lot of ground in this episode, but I thought for our younger family audience, this might be a great high-level primer as you think about your insurance. So anything else you'd like to add, Dan?
Thank you. The last thing I'll say is work with your financial planner, get the advice that you need, and do the things you need to do to manage the risks in your life. Thank you, Tom. I really appreciate being here.
Thanks so much, Dan. Everybody have a great week. Thanks for tuning in. Sandwich Bread Pod is hosted by me, Tom Kaminski. Huge thank you to Lauren Nose, our executive producer, for making this show happen, and to Andrew Maxon of Celebrator Creative Studios for branding and design. And lastly, to Audionautics for our theme music. Are you someone in the sandwich generation? We'd love to hear from you. Share with us your story, and maybe we'll find a way to work you into our podcast, or simply reference the materials and the experiences you've had. We value that very much. Reach out to us at sandwichbreadpod@twinrobins.com or hello@twinrobins.com. TWINROBINS.com. Thanks so much again for listening. The information discussed in this podcast is only for general explanations and education. It is not specific tax, legal, or investment advice. Before acting on anything you heard here, first consult with your tax, legal, or investment advisor. Past performance of any investment discussed in this show does not guarantee future results. Twin Robins Capital LLC is a registered investment advisor offering advisory services in the states of Missouri, Kansas, Georgia, Indiana, Virginia, and in all other jurisdictions where exempt. Registration does not imply a certain level of skill or training.
This is a Twin Robins birthday production.